Hello, Fiona.
Good morning, Fiona. How are you?
Yes, I'm fine, thank you. How are you doing?
Yes, I'm doing very well. Thank you. Right. I did not have time to go through your bubble answer,
Okay.
but just glance through. Looks like I'm very happy. Looks like most of the things have come right, except there's property, plant, and equipment. I saw something, which is not a very big one. So anyway, we will discuss that one also.
Okay.
We will look at little bit on the financial instruments, and I want you to take little bit on the, we know we have done lot of questions on the IAS 19, but it was all about where we have a fund outside, but I want you to take little bit on the easier one also. So let's see what we are going to look at today. And also bubble question, I think I have basically, your goodwill has come right. Property, plant and equipment, there was a little problem. Financial assets have come right. Inventories have come right. Trade and other receivables have come right. Cash and cash equivalents have come right. Equity shares have come right. Retained earnings, there was a little bit. Other components of equity, there was a little bit. I think the non-current liabilities, there was a little bit of a problem. Current liabilities, it was all right. So I will go through that one and I'll give my feedback on that one.
Right, okay.
So we were talking yesterday, when we finished up, it was all about something called a compound instrument. I don't know whether we started on that one, right? It is basically what we call convertible bonds. What do you know about the convertible bonds, Fiona?
Is this in the context of the presentation of them, or?
Yeah, it is in the context of presentation, right? But what is the nature of a instrument when you say a convertible bond? Now, convertible bonds is a way of raising money. You know, when in a company, you can either raise money in form of debt or in form of equity, right? Now, some people, they don't want to invest money on equity because equity is very risky, especially initially. If it's a upcoming company, initially equity can be very risky. There are a lot of uncertainty. So they might decide to invest their money on what we call a bond. Bond. It's a loan. They give the company a loan. But once the company is doing very well, because if you give a loan, you only get the interest, a fixed amount. 6% or 5% or whatever, you get it that forever. That's all. You don't enjoy what we were talking yesterday, what we call residual interest. We don't enjoy the big component or the balance part of it. So after some time, when the company is doing very well, the lender, if he has the option, the company should give him the option, might decide to convert those loans or the bond instruments into shares. So for example, you have invested $1,000 in a company, and the company says it's $100 bond. 10 bonds you have invested. The company says for every $100, the company will give 10 shares, for example. So this is told today. It is told today in 2017. It is told after 5 years in 2022, either you can get your $1,000 back along with the interest what you have got in the 5 years, or at the end of the 5th year, you have the option to convert it into 10 shares for 100. So that means for $1,000, you will get 100 shares. 100 shares, right? So you have the option. The lender has the option. So lender might look at the market price on 2022. If the market price is, say, shall we say 12 per share, right? 12 into 100 is 1,200. Now you have the option of getting 1,200 worth of shares or $1,000 money. Option is yours. What option will you exercise? To convert or to get your money back?
Yeah, it depends how much you need the cash, doesn't it? It depends whether you need the cash or not.
Right, yeah. Yeah, but even if you need cash, shares are just like cash. You convert it into 1,200, go to the market and sell the shares.
Yes, true. Then, yeah, true. Yeah, so you'd go with the shares.
Yeah,
because it's
because you know that can be done only by a listed company because there is a market price for a share. Unlisted, yes, whatever you said was I agree. Unlisted because there is no market. So if you need cash, you might think of converting it into cash. But if it's a listed company where we deal with listed company, always there is a market price, so you will convert it and sell the shares and collect money. You can get another 200 top over and above the normal capital you would have got, isn't it?
Yes.
What happens if the market price has come down to 9?
You'd be worse off then.
Yeah, then you will not convert. The option is yours, no?
Yeah.
You will not convert. What you will do is you will take the 9, you will say, I want my money, $1,000.
Yeah.
Right? So you don't convert. Otherwise you will convert. So this is what we call a convertible bond. Commonly in ACCA examiners language, we call it a hybrid instrument, like a hybrid car, hybrid instrument. It has the loan component and also it can be converted into an equity component later on. The option is yours. Now, I want to ask you another question. Let's assume there is a $100,000 which you can put, no conversion option. They pay you 7% interest all the time. No conversion. There is another one with a conversion option given, right? They will pay you X amount of interest, but they will give you the option to convert it into shares at a later date, maybe 5 years later. Now, the unconvertible one, the first one offers you 7% interest. If you are offered the second one, what kind of interest will you expect? 7 or more or less?
So is the first one the same condition?
First one, no conversion conditions. It's a pure, what we call an unconvertible loan. No conversion option. You will only get your 7 plus the money back, $1,000 back.
Right. And the money's due back in the same time frame.
Same time. Second one, it gives you an option after 5 years either to convert or they obviously you have the option to convert, but they also will give you interest during the first 5 years. My question is, in the first one, if you were getting 7%, what will be you expecting on the second one for the first 5 years? More than 7, less than 7? Or 7? What do you expect? What do you expect?
Yeah.
What do you think? What will you expect?
Yeah, although you've got the option to convert, it doesn't mean you will do, so you'd expect at least the same.
At least the same. Yeah, in a way, yeah. I know the ladies are generally, they take a very conservative approach, but look at like this. Look at like this. In a business environment, right? The first one, no option. You will only get the 1,000. Second one, there is a possibility always the company doing well. Instead of 1,000, you might get 1,200, 1,300, or even 1,400. If the company does well, you're going to get a bigger share price and you might get a bigger gain, right? So because of that, I'm saying you might settle down for a lower rate of interest at the first 5 years because you being a very optimistic business lady will be thinking the shares will go up in price. I can get another $400 towards the conversion, and therefore let me settle down for a 6% or 5% because I'm sure I will get the 5% plus I have the hope of getting a 400, whereas in the first one no hope at all, only the 7%.
Yeah. Yeah, I see what you mean.
Yeah. So what you can see is always the convertible bond will give the coupon rate on the convertible bond will be somewhat lower than the non-convertible bond. The convertible bond coupon rate or the interest will be somewhat lower than the non-convertible bond. Because non-convertible bond, he has nothing more to look forward, but in a convertible bond, he has something more than the coupon rate to look forward through the capital gain.
Okay.
Right? So this is a way to raise money for a company. What's a big advantage for the company? The company, the big advantage is first 5 years or first 7 years, that's the most difficult period for a company because that's the period the project is not so certain. I mean, not only a new company, but even existing company, when you start a new project, the first 4, 5, 6 years are the most difficult period. You have to manage your cash flow. So even a 2% saving on the cash flow can be a huge saving.
Yes.
Right? So the company will have a kind of what I should say leverage, a kind of a breathing gap where they pay less interest and they have the same money. And also one other factor is the earnings per share because the shares are not converted. I mean, not that the shares are not converted, shares are not issued at the beginning. So your earnings per share will not dilute to a great extent. Because there are no shares. It's only a loan. Right? It's only a loan. So there is no earnings per share getting dilution, which is a good thing for a company. At least at the beginning of a project, you must try and keep your earnings per share without dilution. If you go and issue shares immediately, then your earnings per share will get diluted because any project will take some time to generate money. Right? But the number of shares have gone up in the market immediately and therefore it will dilute the earnings per share. So to avoid all that, a good way for a company is to go with a convertible bond. Now once you go with a convertible bond, let's assume that after 5 years that you have the option to convert it. So if I just may put up some figures to explain this one. You are putting up $100, okay? And on the $100 you will get first year because it's a convertible bond, you pay a lower rate of interest. Let's assume you are paying 5. Second year 5, third year 5, fourth year 5, fifth year also 5. And at the end of the 5 years, you will get your 100 back, or you can get the shares converted into the loan converted into shares, which may bring you not 100, may bring you 120, right? Because once you convert, it is not 100, it is going to be 120. Now, what we do is, in the presentation, what you were talking about on a hybrid instrument, we look at all these cash flows. This is a convertible bond, you get a 5% rate. But similar non-convertible bond, the examiner might tell you the similar non-convertible bond, the rate is going to be, shall we say, 7%. 7%. That is, there is another bond which is similar but no convertible, right? So I told you it will be much more than the normal 5%, it will be 7%. So there is,
Yes.
so we discount all these things. Remember, this is what I want you to know. We discount all these things not at 5%, we discount all these things at 7%. Taking the non-convertible rate. So this is your SSC examiner might give a question and say the convertible bond, the coupon rate is 5%, but she will say the non-convertible similar one is 7%, or without convertible rights, it is 7%. So we discount it at 7%. And obviously when we discount it at 7%, the figure that you might get is surely less, the higher the discounting rate, the cash flows will become lower and lower and lower. Let's assume that what we are going to get is 96. The present value of all that is 96. Now,
Yeah.
you invested 100. From the company's point of view, company got cash 100. And the company says the present value of all what you are going to pay as a loan is 96. 96. So the financial instrument IS 39 defines this as a hybrid instrument or a compound instrument, and the entries what we put up is cash with 100, that the big component what we discounted, we call it the loan component, 96. Balancing figure is what we call equity component, 4. So this is what I need you to understand. Whenever we have a compound instrument or a hybrid instrument, we discount all the future cash flows, bring it to the current value, and the difference between what we got and the current value, we say it is equity. Now, one tip I want to give you, always whenever the examiner talks about it, remember the smaller component is the equity.
Yes.
He might not give you all the details. He might say the loan component is 96, then we know equity component is 4, or he might give the equity component, therefore we know the loan component at 96. If he just says A and B and answer or answer, the big component is the loan component, small component is equity. So remember yesterday we discussed at the remeasurement, loan component, what do? We go by the amortized value. Every year we will convert, taking the effective rate, we will take the 96 plus the effective rate minus whatever we pay, $5, we will consider it as amortized value. So this subsequent measurement, amortized. What about the equity component? What about the equity component? Yesterday we learned something. Equity component is never subsequently remeasured. It will be measured at 4 all the time.
Yeah.
Right? So, whenever we have a hybrid instrument, this is what we do. We look at the first part of the component. We discount it at the unconvertible rate. Take that one, put that figure, that is the loan component. The balancing figure what you have got between cash and the loan component is the equity component. And the loan component, we will go like a normal financial liability on the amortized basis, but the equity component, we will keep it as it is. That's all I need to tell you about that one.
Okay.
So it has the both characteristics of equity and liability. So these have been the discussion questions of our ACC examiner. Requires compound instrument to be split into 2 parts. Financial liability, measured at present value of future cash flows, including redemption, using a discount rate that equates the interest rate of a similar instrument without conversion rights. And the equity instrument, balance, calculated as a balancing figure. This must be shown separately in the statement of financial position. The equity part will come under equity, loan part will come under current liability. So it will be a complicated one for people to do when they are doing the presentation. This is what IAS 32 permits. Even in the IFRS 9, no change, it will be the same story. So subsequently, liability component is measured on amortized basis. Equity component will never change because we said equity components are never change. Any transaction cost, you remember if it is the transaction cost, what we will do is if it is say some 10 million or something like that, we will split on the proportion for the 96% of the 10 million, we will put it as the loan transaction cost. The 4% we will put it under equity transaction. So that's how the transaction cost will be prorated. So remember, always whenever we take a loan or a liability, the transaction costs are deducted, the net amount is shown, and equity also, it will be the same story we will do. The net amount will be shown, except the fair value to profit or loss, where the transaction cost is charged straight to the P&L. So yesterday we discussed in a little way the financial assets, the 4 financial assets. Fair value to profit or loss, held to maturity, loans and receivables available for sale. These are the 4 financial assets. Financial liabilities we have only 2. Fair value to profit or loss and financial liabilities. Financial assets we have 4. Fair value to profit or loss, held to maturity, loans and receivables available for sale. Now, fair value to profit or loss essentially short-term kind of investments. You buy shares in a company with the idea of just keeping for 2 months, 3 months, 4 months, and you want to sell and make a money. In that case, it is called fair value to profit or loss. So just like the fair value to profit or loss liability, any transaction cost. Now you buy a asset worth 100 million. You buy an asset worth 100 million. And you spend another 2 million as transaction cost. Now, how will the entries be reflected? Right? If it is fair value to profit or loss. You buy an asset worth 100 million, the fair value is 100 million, but you have to spend 2 million. So altogether there's 102 million cash going on. So obviously we'll credit cash with 102 million.
Yes.
102 million. Now, how much will you put it as asset? How much will you put it as transaction cost? If it is fair value to profit or loss, the asset will appear at the fair value 100. And P&L will be debited with 2. So this applies only for the fair value to profit or loss. So remember when we took the liability, 100 minus 2, 100 is the amount. So we will show 100, but the 2 we will charge it to the P&L. Similarly here when we buy asset, we charge the transaction cost to the P&L. Right? So that's what we do. Now, let's assume it is not a fair value to profit or loss, but it is either held to maturity or loans and receivable are available for sale. In that case, for all these three, the accounting entries, cash credit 102, debit the asset 102. Is it clear? Only the first one that you debit the P&L with the transaction cost. All other three add the transaction cost and show the full value, including the transaction cost 102, 102, 102. Now, what can be categorized as a fair value to profit or loss is simply short-term investments, short-term trading investments, and derivatives. Derivatives are like the forward rate agreement, the futures, essentially all short-term kind of a thing. Held to maturity is a fixed deposit which you hold it for a longer time. At least the intention is to hold it for a longer time. Not at least, the intention should be to hold it for a longer time. So I remember there was a ACCA question. The company bought some fixed deposits, or they invested some money on fixed deposit. The maturity period was 2020, but their intention was not to hold it till 2020, right? And they were asking the accountant, like yesterday's case, to be shown under long-term assets to be shown under long-term assets. Now, can you do that one? Because they want to get a bank loan and they want to show it under long-term assets so that the balance sheet will look much more stronger when it is shown as a long-term asset. The answer is you can't, because the intention, even though the fixed deposit is going to mature in 2020, their intention is not to hold on till 2020. They want to get it prematured, maybe at 2018. So therefore, it cannot be held as held to maturity, even though the maturity date is 2020, if you don't have the intention. So the key word is to see the intention. Also another thing, right? You might be intending to hold it for 2020, or rather, at least you say on a pretended basis, you want to hold it for 200 till 2020. But your cash flow position is so bad, you know inside, internally, your finance director knows, you know that you cannot hold on. Because the liquidity position is so bad, you will have to encash it much more earlier. So even though you might say the intention is there, the ability to hold on is not there. And therefore, again, it cannot be treated as held to maturity. So you must have the intention also and the ability both. So generally things like debentures, things like preference shares fall into this category. They are essentially unlisted. They are essentially unlisted items like preference shares or debentures or anything, or it can be even listed. It can be even listed, but the intention is to hold it for a longer time. Fair value to profit or loss, it's listed, but the intention is to hold it for a shorter time. Loans and receivables, they are basically not listed. So this is the difference between held to maturity and loans and receivables. Held to maturity always listed items, but you have no intention to, your intention is to hold it for maturity. Loans and receivables, they are not listed. They can get matured. They are basically your trade receivables. You give a loan to another company. They are not the marketable kind of a thing. You give me a loan, that will appear under loans and receivables. What is available for shares? Anything that is not falling into any of the three categories, we will put it under available for sale. So it's like a nobody's child. This is where a lot of manipulation happens. So this is what the IFRS 9 is going to remove it, because they put everything under available for sale. Now can you think of looking at the line number 1, line number 2 and line number 3, can you think of what that can fall under available for sale? Line number 1 is all listed short-term investments. Line number 2, listed somewhat debentures, preference shares, that kind of thing. Line number 3, it has a maturity date. Line number 3, essentially unlisted short-term loans, that kind of thing. Receivables, trade receivables. What can fall under the fourth category?
So would it be things like investing in the money market, where you're just doing it for a day or so and then getting your money back?
That will definitely fall under fair value to profit or loss.
Okay.
Yeah. That will fall under fair value to profit or loss, because they are short term. Essentially short term.
Yeah, I miss it.
Yeah. Preference shares, definitely it will fall under held to maturity, because the idea is to hold it till 2020 redemption. Loans and receivables, yes. What can fall under available for sale? Almost all the finance directors, financial controllers are trying to put everything under available for sale. This is what the accounting standard body is going to remove from January 18. They can't dump anything under AFS. So what can fall under AFS at the moment? What can fall under AFS is long-term listed shares.
Yeah.
Long-term listed shares. If you invest in a company like an associate company, like a subsidiary company, in your parent company books, it will appear not in the consolidated. In the consolidated, it will get cancelled off, but in the parent company, they will be treated as available for sale. And you will see this in your ICCA question number 1 all the time. They will put this as available for sale, right? So they are long-term kind of assets, but listed company shares maybe, and that is kept for long-term purposes. So this is what we work out on the tree. So initially, fair value to profit or loss, we recognize the transaction cost as a P&L charge, and only the fair value will appear as the value. Other tree, all tree, it will appear at 102. Now when it comes to the subsequent measurement, another complication here, subsequent measurement, say after 1 year, after 3 months, this fair value to profit or loss, what was shown as 100 has gone up to 101. So you revalue at 101 and there's a gain of 1. That one you will charge it, you will take it to the P&L. You will take it to the P&L. If it's a loss, you will take it to the P&L. If it's a gain, you will take it to the P&L. So you will restate the number 1 at fair value to profit or loss and charge that 100 and the gain to the P&L. Now, for the moment, let's hold the second and third. Let's go to the fourth one. Fourth one is available for sale. Initially, you will show it at 102. Let's assume at the end of the year, again it is restated at fair value, right? Let's assume the fair value is 104. 104. So there is a gain of 2. So that we will show, but we don't, so we will revalue it at 104. We don't take it to the P&L, we take it to the OCI. Remember in your examination questions, we came across this one sometime back when we did 90 to 95. What did they do? That 5 million restated value, which is the right thing to do, they have credited it to other comprehensive income and they are credited into other components of equity. So whenever there is the consolidation, we have to remove that one because that 5 million is an internally generated entry. So we remove that one. But in the single entity, that's the right thing to do. Right? If it is short term, it will go to the credit of P&L, but associate company investment, subsidiary company investment, it will be shown at the restated value and that difference will be charged to the P&L. Sorry, to the OCI, other components of equity. Now, that is why you remember whenever they dispose a subsidiary, we have to recycle that amount from the P&L, from the OCI to the P&L. Now, this is an item which gets recycled. Yesterday, we discussed the item that is not getting recycled, but was that the gain or loss on benefit funds. The pension funds, the gain or loss is never recycled. This is a recycle item, right? The gain or loss on available for sale will be recycled. So this is where there's so much of confusion on the OCI what to be shown and on the P&L what to be shown. This will be recycled the moment you dispose the investment. Till the investment is disposed, it will be shown as a OCI item. Fair value to profit or loss, there is nothing. It will be straight away taken to the P&L. So it need not be only an associate or a subsidiary. It can be anything. It can be any investment that is categorized as available for sale. All the gains and losses will be shown in the OCI. The day that you dispose the asset, you have to take it from the OCI through recycling to the P&L. So this is what I thought always. It is the what is recycled is always the realized gain. But when I read that your examiner's article, I realized that is also wrong. because foreign exchange, even when it is realized, we don't recycle. So this is why your SSC examiner is very, very good on targeting us on this OCI and the P&L part, because there are many, many different ways, many, many different treatments, and this is a bit of a confusion one. So right at the moment they are working on this as this thing. Surely, I'm sure they will have something new coming up very soon for us. But before that, let's finish up our exam. So then we come to the second and third, held to maturity and loans and receivables. You remember I told you yesterday about amortized cost? Same thing will apply for both number 2 and 3, just like a liability. We will take this figure 102, which is an investment for us. So on 102, we will work out, the examiner will tell the effective rate. Let's assume the effective rate is 5%. So on the 102, 5% is something, right? 102, 5% is 5.1. I will add that to my asset. P&L 5.1. So 107.1 it will appear now. I might get $6 the coupon rate of interest. It will appear at 101.1. This is what I call amortized cost. So actually held to maturity and loans and receivable should be rightly presented through amortized cost. 102 plus 5% less the amount what we receive. If you remember the loans what we do, 102 plus 5% added less the amount what we pay, we will show it as the liability. So same story will apply here. For held to maturity and loans and receivables, we should be applying that one. Is it clear now?
Yes.
Bit complicated, but so long as you can, so long as you know exactly the few things to know. Number 1 and number 4, we restate it at fair value. Number 1, the gain straight to the P&L. Number 4, gain to the other comprehensive income. Number 2 and 3, it's the amortized we take, the effective rate of interest we take it to the P&L. The balance part we will show it under. The amortized cost we will show. So it is not restated at fair value. It will be shown always at amortized cost. Having said always at amortized cost, now for example, at the end of the first year, this financial asset will appear at 101.1. The examiner might say on a revaluation or on a fair valuation, the asset is worth only 98. Now according to IAS 39, IAS 32, it is 101.1. Examiner will say it is revalued at 98. What should I do? What should I do with the difference 101.1 minus 98? 101.1 is the value of the asset as per books, but the examiner says the fair value of the asset is 98. We don't use the fair value treatment, but when the fair value comes up, what are we going to do?
And which one's this for?
Second and the third. First and 4, no problem, because there is no, it's always at the fair value, Fiona. First and the 4, it always revalued at the fair value. Second and third, we go by a book method, but the examiner says it has a fair value of so much. 98, for example, I'm saying. Then we have the impairment of asset coming up, IAS 36. Whenever the fair value of asset is less than the carrying value, the difference should be charged to the P&L. So the second and third, there is a possibility of a impairment. 1 and 4, no possibility of impairment. 1 and 4, always it will be at the fair value. Gains or losses, 1, it will be charged to the P&L. 4, it will be charged to the OCI. These are in the financial instrument. These are the tricky areas which we need to know and do very well. So Measurement of financial asset, as we discussed, fair value to profit or loss, initially transaction cost charged to the P&L. Other trade, it is always added to the asset value, 100 plus 2, 100 plus 2, 100 plus 2, right? And then restate at each reporting date any gains or losses taken to other comprehensive income. The fourth one, when the asset is sold, gains or losses recycled through P&L. So now we have two examples. One where the recycling happens, that is available for sale. Second one where the recycling not happens is when the measurement of the employee defined benefit, that one recycling is not permitted. Yesterday we had a question whether recycling is permitted. No, not permitted. HTML non-receivables, second and third, it's amortized cost that is credited to the P&L, and any interest received or debit is credited to the asset account. Measurement of financial assets, as I said, it will only apply to HTM and LNR because the other two are measured always on the fair value, so there is no impairment. Second and third, since it is measured on a book value basis, based on effective asset, it can have an impact. And therefore, IS 39 says, each reporting see whether there is any evidence of impairment. If there is evidence, complete review must be done. And impairment loss is the difference between the carrying value and the present value estimated, discounted at the asset's original effective rate. Impairment losses are recognized to the P&L straight away. Whenever a financial asset is sold or disposed, then that means we must de-recognize. Now this is also another important area of your ACC examiner, the de-recognition of financial assets. The day that you have to forfeit or you have to sacrifice the contractual cash flow, then that's the day you have to de-recognize. So, for example, a bad day. You show it as a loans and receivable, but the day that your liquidate of the other company informs or receiver informs saying that company has gone for liquidation, remove it because it cannot be shown as a financial asset. If you show it as a financial asset after that, it is unethical, illegal, and should not be done. When the substantially all the rewards of the ownership of the financial asset is transferred, right? So you don't have any more risk, any more rewards, then at that point it should be de-recognized. Now, for example, leasing companies, when they give you money for a lease, they can recognize that as loans and receivables. But the day that you repay the entire lease, that must be completely removed from their books because they have to de-recognize, because after that there is no risk for them, no rewards for them of any loan coming up. Upon de-recognition, any difference between the proceeds and carrying value is recognized through the P&L. So for example, you might show in the books to get loans and receivables 95 million, you might get only 92 million. The 3 million, if it was on a reporting date, it was there, it will be an impairment. But not on a reporting date, you showed it at 95 as at today, 28th of February, but the customer pays full and final 92. That's all. You are not going to get anything more. That 3 million should be charged to the P&L straight away. You can't hold it because it is recognized. Asset was classified as available for sale. Any gains or losses accumulated in the other comprehensive will be taken back to the P&L through recycling. So you have to remove it from other components of equity, debit other components of equity, and credit your retained income of P&L with that amount through the OCI. Another one is factoring. What is factoring, Fiona?
It's when you sell your customer invoices to Great Finance, so you then you would receive a percentage up front when you raise invoices, so it's a way of getting cash instantly rather than having to wait for your customers to pay you.
Very good. Very good. There are two ways what we do. One what we call with recourse, the other one we call without recourse. What is the difference between with recourse and what is the difference, what is with recourse, with and without?
With recourse or without recourse?
Say you have sold some goods to me, right? You have sold some goods to me. I'm your customer. I have to pay you 100,000. Now you have given me 60 days credit. So you don't want to come and disturb me and ask money before that. So you go to a factoring company and say, Kumar owes me 100,000 and you factor. And you might get 98,000 money. Right? 2,000 is the factoring company's profit. You will get 98,000. You are very happy because you did not go and disturb Kumar. Because if you disturb Kumar, Kumar might think, you are in some crisis and he might not buy goods from you. So because of that, you went to a factor and got your money. You are happy. You can manage your affairs. But only you have to sacrifice 2,000. It's worthwhile because you have got your money up front. Now factoring company at the end of the 60th day will come to Kumar and ask money. And if Kumar pays 100,000, very happy, factoring company, they gave you only 98, so they have a 2,000 profit. They will take that into the P&L and do it. What happens if Kumar says, very sorry, I can't pay you, right? There only, it depends on whether with recourse or without recourse. If it is with recourse, the factoring company can come back to you and knock at your door and say, hi Fiona, Kumar did not pay.
Oh, okay.
Yeah?
Right. Because isn't there normally an insurance for covering?
Yeah, that all depends. That all depends on the way that you are factored, the way you are factored, right? They will come and say, hey Fiona, good evening. That Kumar did not pay. I want my 100,000 back. So not 98,000. He will ask for 100,000 from you, right?
Yeah.
And you have to pay. That is where you have done with recourse, where you have given a recourse to the factoring company to come back to you. Without recourse means if Kumar did not pay, they can't come and knock at your door. They will have to just take care of the bad debt. If they have an insurance cover, they may be able to recover something. Otherwise, forget about it. Obviously, without recourse means they are taking a bigger risk. In that case, they might not give you 100 minus 2. They might give you 100 minus 4.
Yeah.
Bigger factoring fee because they are taking a bigger risk, because when Kumar does not pay, they can't come back to you. They have no recourse to you. This is what we call with recourse and without recourse. So the factoring company assumes responsibility for collecting the amount outstanding from the company. And in that case, in accordance with IAS 39, now if it is without recourse, right, if they can't come back to you, you can de-recognize that asset from your balance sheet straight away. Right? You can de-recognize the balance sheet asset straight away because you will only get 98. So you will debit cash with 98, credit the liability, credit the asset with 100, and 2 you will charge it to the P&L. You can de-recognize. But if that man has the right to recourse to come back to you, you can't de-recognize your asset till that day. Right? Yeah. Because if they don't pay, if Kumar does not pay, they will have the right. So in that case, the money what you have taken from the factoring company must be shown as a liability, not as some, you can't de-recognize the asset. You have to show it as a liability till the 60th day. Once the 60th day comes, when everything is okay, you can de-recognize. So this is very, very important for you to understand. This happens with recourse and without recourse. So in accordance with IAS 39, the entity should de-recognize the receivables only if it has transferred all the risk and reverse of the ownership. If it is without recourse, that means you don't have any more risk of a bad debt. If Kumar does not pay, that's not your baby. You can de-recognize the asset. But if they can come back and ask the money, then you can't de-recognize. Factor, yes. Consider, does the factor have the right of recourse? If the factor has the right of recourse, you can't derecognize the asset today. So these are the good ACCA questions. They might say a similar situation and say the board of directors want to derecognize the asset. Is it possible? No, right? Because the factor have the factor, if the factor is having the right of recourse, then you can't derecognize. Who bears the risk of slow payment? Kumar says Kumar can't pay it on the 60th day. Kumar says Kumar will pay in installments. Now, if it is recourse, with recourse, the factor will say, very sorry, you deal with that with Fiona, that's not our baby. But without recourse means the risk of slow payment is resting with the factoring company. Can the factor only recover a fixed amount? And if it's so, does this reflect the majority of the receivable? Now, for example, Kumar owes 100,000. At the end of the day, when 60th day comes, when it happens, when Kumar is not going to pay, the factor recovers a fixed amount. He can recover only from you, from Fiona. He can't recover the 100,000. He can recover only 10,000. The majority of the amount is still the factor's risk, right? So your risk is only 10,000. Out of the 100,000, your risk is, if Kumar does not pay, you have to pay only 10,000. In that case, you can derecognize. But if you have to pay the majority, 80,000, 90,000, then you can't derecognize. SEMA examiner does not go into these details, but ACC examiner goes lot of details into this type of thing.
Yes, yeah.
I have not seen recently in the papers a question on things like factoring. So better be ready for this kind of question. This is under IAS 32, IAS 39. In instruments, we know it is basically a kind of, you have to hedge something. What do you mean by hedging? You want to manage your risk of a particular transaction. Like, for example, you have sold some goods to me. I'm going to pay in my own Sri Lanka rupees to you in another 3 months' time. And by the time the 3 months come, your sterling may have got appreciated. And in that case, you will get little money than what you originally planned for. So because of that, you may have to go and do a little bit of a risk management by taking what we call a forward rate agreement. So that kind of a thing is essentially short term, and the characteristics of a derivative, the three things, it is the value of the forward rate agreement changes in response to the main transaction. Very little capital is invested. You just go and enter into an agreement with the banker. So there is no immediately big involvement, but later on, at the end of the 3 months or at the end of the 6 months or whatever, you have to settle or you have to honor your obligation. So when Kumar pays that 100,000, you have to go and sell that one and take your own currency at that predetermined rate. So this kind of a thing is also now we need to account, even though there is no immediately a capital investment, we still have to take on each reporting date and report it on the balancing date, taking the possible loss or possible gain and show it. There are 4 types of derivatives: forward rate, futures contracts, but this is not part of your syllabus in the P2. The types of derivatives. What you need to know is little bit about the accounting. Whenever we have a similar situation, which must be treated as fair value to profit or loss, short term, fair value to profit or loss, and treat it as a liability or as an asset, depending on whether there's a gain or a loss. So nothing much to worry about that part of it. All derivatives, remember, are recognized as fair value to profit or loss because they are short ones, and therefore initially actually there is no investment, but as you come along towards the end of the period, you might find on the risk that you have taken, you are losing. In that case, it's a liability. On the risk you are gaining, then in that case, it's a asset. So asset debit, credit P&L. If it's a liability, credit liability, debit P&L. That's all we need to do. So this is just a little bit for you to understand on the financial derivatives that we did. Right? So we have a little bit of a time. Shall we look at a little bit on the IAS 19? Hello?
Hello. Yes, sorry. Yeah.
Shall we look at IAS 19 a little bit?
Yes, okay.
Yeah, because you remember we have done a lot of work on this area, and almost in every question we had IAS 19. I think even in the bubble question there was IAS 19. But you have to remember there are two types of plans, right? Pension plan consists of pool assets, liability for pension owned to employees. Pension assets normally consist of investments, cash and other properties. There are two types. One we call defined contribution plans, other one what we call defined benefit plan. So what is a defined contribution plan? All the time on all the SCCA questions what we came across, we had defined benefit plans. That is,
yes,
we have basically told our employee that at the end of the retirement, whatever his last salary or whatever, he will get 80% of the last salary or 90% of the last salary till he goes to heaven. He will be getting that amount every year. So that is what we call a defined benefit plan, right? So he has absolutely nothing to worry. He will get his money because what happens is the company also does not take a risk. Company goes and invests that part of the contribution in a separate benefit plan, right, inside the company, but it is managed to a different administration. They will keep enough money to work through the pensions, to looking at all the employees, their age, their behavior, all that. They will work out and they will guarantee that amount continuous. Right? The other one is on behalf of you, when you join the company, you are told on behalf of you, we are going to contribute so much to the pension fund, outside pension fund. That has nothing to do with us. And, we contribute that amount and they will manage. And this is what we call a pension funds, etc. They will, depending on their profit or their loss, they will give you a pension when you retire. So the company has no more obligations. Right? So generally a fixed percent of salary, 10%, 8%, 12%, they will give it to that pension fund. That's the end of the story. The pension fund will manage. If they go and invest in good investments, you might get a bigger pension. If they go and invest in bad investments, you might get a lesser pension or no pension at all. That's your luck, bad luck, good luck, all that. So that kind of a thing, what we do is, we don't have any other things to look at. Hold on for a second, Fiona.
Okay.
Hello. Hello. Oh. 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 Master no. Oh. No. Hari hai. නෑ අපි එදාට එනවා කොමට 16 වෙනිදාට. සමන් 7 නේ තියෙන්නේ කොමට? ඔව් හම්බුනේ නැහැ ඒක. එනවා 16 වෙනිදා ෂුවර් එකට. ඔව්. අංක 6ද 3ද දන්නේ තියෙන්නේ නේ? 6 නේ? හරි. රයිට්. හරි. මොකද නඩුකාරයා මාරු වෙලා මං හිතන්නේ ඒකේ. මේ එක ප්‍රශ්නෙන් අපි එනවා කොමටත් එදාට. ඔව්. හරි. රයිට් okay. So this one, no problems.
No, it's a fixed contribution,
yeah,
so there's no other
contribution. So it has just you have to charge it to the P&L and that's it, right? The other one is all the big problems are with that one. This is what we were looking all the time. So here we have to look at, now you might have a question like this. You know, all this time he gave all the figures, no, but what are the factors we have to consider in working out these benefit plans? So we have to consider the age of the people. We have to consider their length of service, right? A person who is joining when he's 50 will have only another 10 years to go. A person who is joining 20 years will have a 45 years to go. Inflation factors will need to be considered and all that, and we will have inside our company separately a fund managed for this purpose. So what happens is at the end of every year we have to find out through an actuarial valuation our liability, our expected liability. Now as per our books, the liabilities, the opening balance plus the interest minus any payments what we have done is the book liability. But the actuarial valuation might say the liability book value is 80 million, actuarial value say unfortunately your employees are going to live more than what you plan and the liability is going to be 85 million. So that 5 million is what we call, you remember, remeasurement gain or loss. When the liability goes up, that's a 5 million which you have to charge it to other comprehensive income. The liability goes up by two amounts. One is the interest, that charge it to the P&L. The other one is the service factor. Extra 1 year service means extra 1 year of pension. That is what we call service cost. Charge it to the P&L. The difference between the fair value of the liability and the book value is what we call the fair measurement gain. Charge it to the OCI. The other side of this is matched with what we call planned assets. All those money we don't keep it inside the company, because if we keep it on the inside the company, what will happen is it will be invested in things like inventory and receivables. When the person retires, you won't have money to pay. You can't ask him to carry the inventory. So what you do is you go and invest this money in separate investments like shares in another company, like the government bonds, treasuries, etc. You will invest, and that will earn interest. So that interest minus the interest what we have to pay will be credited or debited net to the P&L. Then that fund will grow up by additional funds given by the company. Now that it is not going to have any impact on the P&L. It's just a transfer of funds from the company to the pension fund. It's a cash flow item. It will have an impact on the cash flow but not on the P&L. Then whenever we have to pay, we will withdraw money from the pension fund, pension assets, and pay to the pension liabilities to settle. That's the idea, so that the company funds are not eroded when a person retires. And then again, at the end of the year, we have to measure the value of the assets. According to the book, it is opening plus the interest, minus any payments what we have done, plus any contribution the company has given. That figure is 95 million. But when the fair value is done on the assets, it is 98 million. Then we have a 3 million gain, which should be taken to the OCI.
Yes.
This is one set of entries where we have the ability to net off the interest receivable on the pension assets. Interest payable on the pension obligation can be net off. The net interest can be shown under finance charges. The service cost is always a part of the employee remuneration cost, and that should be charged to the administration. Then the OCI on the two things can be set off if there's a loss and a gain. If both the sides are profits, you can show it under OCI, both. If both sides are losses, still it will be OCI. Then the asset and the liability will be net off, and the net asset will be, or the net obligation will be shown. And in most of the ACA questions, we see the net obligation shown, and that net obligation only we have to either charge interest, or if it's a net asset, we take credit of interest. So these are the few things which you need to know, and defined contribution plans, always the defined contributions, PL as an employee expenditure. This is the earlier one. There can be prepayment or a liability arising, and IAS 19 just requires the disclosure. So these are the few things which I want you to look at. Defined benefit plans, what we were talking about. The entity will set up a benefit plan covered with assets, and it is separated from the entity because it does not want the company monies to get mixed up. So they put a separate money for that purpose, and they will try to manage it. So this is all what I need to look at. So tomorrow we will look at the bubble question little. There's very not too much to look at on that one. We will look at the bubble question, and any other area you want to do tomorrow. We have some questions, I think, and one of the 20. My sincere guess is you are very strong on the 50-mark question, but maybe in the 25 area you may have to do a little bit work.
Yes, yeah, I'd agree with that. Yeah, I think I don't know if you've got another question on cash flow.
Okay. Okay. Yeah.
Not to go through, but for me to do on my own.
Okay, sure. Yeah. I'll try to send you a question on cash flow also.
Yeah, because I've had a look at P&Ls and statement of financial position, and I haven't done cash flow for probably 3 or 4 days. So now I'm thinking the exam's Tuesday. I need to have another look at another cash flow.
Sure. We will look at something. I'll send you a question for you to do it. When is your exam?
On Tuesday.
All right.
Actually, one other question I thought of is just on joint ventures.
All right.
I haven't seen a question with a joint venture in it, and when I was going through yesterday, I thought that's not going to be an area that's going to trip me up again, is it?
Yeah. I did not come across any questions, but I'll see. If there may be some questions, I'll try to pick up something for you.
But maybe just a quick run through on joint ventures.
Okay. Yeah.
But I haven't seen joint ventures in past.
Yeah, because there are joint ventures, joint operations, all that things that has come up. We'll quickly have a look at on that one also tomorrow.
Yeah. I don't think we need to spend a long time on it, but maybe just.
Sure. Yeah, that's it. Yes. Right. Okay. I'll see you tomorrow then, same time.
Okay, thanks, Kumar. Have a good day.
Bye. Bye.